Official cash rate. The thing you never really thought about, but you're starting to see it every day in the paper, the thing that's going to drive your mortgage more than anything else. What is it and why is it important? So, the official cash rate is the primary mechanic that the Reserve Bank use to control inflation. So at its core, the Reserve Bank's job is to create a stable financial system. That means that they are actually the bank to the banks, and they also need to control inflation. So being the bank to the banks, they are able to lend to banks and borrow from banks. So if a bank has a little bit too much money, they can put it with the central bank, and they get paid the official cash rate. If they don't have enough money, they can borrow from the central bank to a certain extent, and they pay the official cash rate. So therefore, any changes in the official cash rate get pretty quickly reflected in deposit rates, because if they can borrow off the central bank at a certain rate, they're going to do it there versus borrowing off depositors. And if they can lend to the central bank and get a certain number, they're going to prefer to do that than pay it out to mortgage holders. So it's the mechanic that really controls interest rates on the way through. And interest rates are critical for controlling inflation. Higher interest rates, that means less money going into the economy, because all of a sudden your mortgage cost has grown from $2,500 a month at a 2% interest rate up to $6,000 a month at a 5 or 6% interest rate. That's a whole lot less spending you can do. Quite technical, quite complex, a horrible video, sorry, but something that needed to be said.